So good morning, everyone. Welcome this morning to Joanne Hart, Investments Editor at the Mail on Sunday. Welcome to Gervais Williams, Head of Equities at Premier Miton, and George O'Connor, Managing Director at Stifel Nicolaus Europe Limited. We thought before we all go off on our Easter egg hunts this year, we'd reflect on the UK markets from last year and look a little bit at how things are developing and shaping up so far in 2021, which to all intents and purposes seems pretty good. There's lots of reasons for us all to be cheerful: vaccine rollout, free trade agreement with the EU, global economy recovering, the weather, a global fiscal and monetary stimulus much bigger than in 2008, and the UK consumer has excess savings. So what is there not to like? The IPO market in London is certainly picking up, and it's where all the excitement seems to be right now. So Trustpilot, Moonpig, Dr. Martens coming to the main market, PensionBee and Deliveroo, obviously work in progress right now, and Tiny Build, Virgin Wines, Power in the style all on AIM in the last few weeks, as well as, of course, Samarkand, Oberon, Rogue, Baron on the Aquis market. I guess what further impresses me and makes me proud to work in financial services in the UK is the choice of markets available to all of us advisors. So let's start with AIM. Is it making a comeback? It's certainly been on a downward trend for the past few years, but finally that seems to have turned a corner and AIM is picking up a little bit. We saw video games publisher Tiny Build list on AIM earlier this month, so the largest US company to list on AIM with a market cap of 470 million US post-listing, raising half of that at the IPO. So perhaps coming to the panel, do we think AIM will continue to build from here post certainly a really good clear out over the last few years? Was that much needed? Do we think investor confidence in AIM has risen given the perceived toughening of regulation? So perhaps I'll throw that one open to maybe George. Have you got any thoughts on AIM and how that is looking to build from here, and any comments to clear out?
Hey there, Claire. Thank you very much for inviting me on your panel. I'm a huge fan of your Feast product, and of course, big up to the Small Cap Network as well. You had a couple of points in there on AIM. First off, you sidled into the notion of clear out, which is what we had seen on AIM previously. And for me, that's a good thing. This is an opportunity to reboot. And in fact, we saw it post .com as well. However, currently, there is no shortage of companies looking to IPO in London. We've got an team over at the exchange. Claire is there, Neil Shah is there, Chris Mel, who are going out actively talking to companies. In addition, I would recommend picking up the Tech Nation report. That's the State of the Nation report. They've identified 80 private unicorns in the UK. So this is a golden age in terms of company formation, and also, of course, for technology. I appreciate that through lockdown, I may have put on a little bit of weight, but in fairness, it's not me eating the world, it's software doing it. So I think we're at the start of a really nice roll. You mentioned a number of companies coming to AIM. The one you didn't mention popped out yesterday, a company called ActiveOps, 120 million market cap, classic AIM territory. So yes, I see a golden age ahead of us.
Thank you, George. Gervais, what's your view on AIM? What's your view of the clear out on AIM over the last few years?
Yeah, it's interesting because I know you talked about clear out, and I'm not sure that we're always clever enough to work out what's to clear out and what we shouldn't. Some of the recovery stocks turn out to be a lot better than expected. I mean, if you take AIM from the period of the Brexit referendum, which was in June of 2016, actually AIM has risen by about 12% per year. It's up about total return about 74%. So for a maligned stock market, that's a lot better than just putting it into inflationary stock. I mean, especially when you compare it with the all share index or indeed the small cap index. So I start off by saying, actually, I think it's been fine for the last few years, although there's been winners and losers, and we've had quite a lot of setback in the UK because of Brexit uncertainty to do with that. But I do welcome the enthusiasm for investing in small quoted companies, and I do welcome new companies coming to market, albeit that I'm probably a lot more cautious about all sorts of areas like companies which tend to come at very large market caps, high valuations, where they've perhaps been dressed up a little bit to come to market, as opposed to companies which are perhaps less high profile and perhaps more overlooked, where perhaps the valuation is lower, but more importantly, they generate more return going forward. So I'm probably a little suspicious of the most high profile issues.
Mm-hmm. Thank you, Gervais. Joanne, do you have any further thoughts?
Well, I agree with Gervais. I'm a bit suspicious of some of these very kind of dressed up companies. I was reading an article only this morning saying, is it any coincidence that Deliveroo, Moonpig and Virgin Wines are floating now just after a year of lockdown? Well, of course, we've all been doing more of that kind of stuff when we haven't been able to go out, but will those valuations be, or will those companies prove sustainable once life returns eventually to normal? So I tend to, like Gervais, try and look through the kind of faddishness. But I do agree that, when I talk to companies who are listing or who have recently listed, and some of them international companies, I always say to them, why have you chosen AIM? And they just say that they like the market. It's not as it's perfectly positioned for smaller companies, as opposed to say NASDAQ, where you can't get on until you're already quite established. And they like it, and I think AIM now has achieved a good balance between regulatory oversight, but more freedom for junior companies to get on the ladder.
Yes, certainly. I mean, maybe let's take it even smaller than AIM, because it's a small cap panel. Perhaps let's just touch on Equities very briefly. So there was an article in, I think it was Investors Chronicle last month, talking about trading in Equities shares soon featuring on IG, AJ Bell, Hargreaves Lansdown platforms. So Equities obviously span out of the Next exchange from CME Group last year. And gives investors very early stage exposure to early stage companies. So we've seen a couple of IPOs on that market this year already, and it's still home to a number of brewers, Shepherd Neame, and the Kent-based winery Chapeldown, and a private bank, Arbuthnot Banking. So it's been around for a long while, but it's making a little bit of a comeback. So for the panelists, sticking with this idea of small caps and perhaps even retail investors, retail involvement in IPO, which is something that some of these platforms have written to the exchange about. With Equities opening up to retail trading on Hargreaves Lansdown, IG and AJ Bell, do we think this is the big turning point for this market? Do we expect to see more companies coming to Equities? And Gervais, I'm looking at you, because I know that you're a supporter of Equities and have picked up a number of well-performing companies there over the years. I hate to say it, but you're on mute. You're still on mute, Gervais.
Sorry, yes, no, I put on mute. Yes, I come to this really liking variety. As I say, it's very difficult to know what's going to be successful in the future. We didn't know this time last year how bad the pandemic would turn out to be. So there's lots of things which turn out very differently from what we expect. So having a variety gives you resilience. You can find things which can not just survive, but sometimes thrive. And one of the things about the last 12 months is that although stock markets have been quite volatile, generally up, in spite of the pandemic, small quoted companies are often their smaller market positions. They are immature businesses. They can grow when the world's not growing. They've got the ability to kind of run around the feet of some of the companies which are losing out. So all of that's great. So coming back to Equities, Equities brings perhaps slightly earlier stage companies, slightly smaller quoted companies. And actually, I think from that point of view, that's brilliant. I think I particularly emphasize that markets are about liquidity. And to maximize liquidity, you do need private investors. You need different investors. You need institutional investors. You need family investors who are holding it for a very long term as well. So ultimately, I think a mix of different people with different time frames, different perceptions improves the marketplace, maximize liquidity. And if you get maximizing liquidity, then that means you can access capital. It's not just the flotation. It's about coming back and speaking to your shareholders and getting the support to do a transaction, often at difficult times. Perhaps the market was a bit low. You think of some of the transactions which happened about this time last year. Some of those have been sensational, actually, when they've made acquisitions at the bottom of the market. So from that point of view, I'm very supportive of Aquis. It is a bit different. We do invest in Aquis for our clients. When we're very comfortable with that. So our best returns have been generated on Aquis stocks. So we're very, very upbeat about the ability to have a wider range, not just AIM, not just main market, but Aquis.
Thank you, Gervais. So maybe moving on from IPOs, I know we've got a lot that we want to get through this morning and discuss as a panel. So perhaps let's dive in with some of the kind of hot topics so far, back end of last year, early this year. Let's look at Bitcoin, for instance, big polarizing topic of 2020, Marmite currency. With countries such as India threatening a strict ban on the digital asset, it's done kind of little to curb the hysteria around its meteoric rise. So, I mean, success stories behind the returns come quite close to UK investment manager land, with Ruffer turning their Bitcoin investment into a very tidy profit. So perhaps asking our panelists, as large corporates such as Tesla and Morgan Stanley, BlackRock are starting to take Bitcoin more seriously, when does the panel think the UK will see greater adoption? Is the space for it in a diversified portfolio? Is the space for Bitcoin, or investors better off investing in companies that benefit from the functionality of the currency that it offers and that enable the ecosystem rather than Bitcoin itself? George, any thoughts?
Good one. So firstly, I'm a big fan. I love the underlying technology. The underlying technology is called blockchain. We're very much early on in the evolution of this technology, and you're always looking for somewhere sensible to invest in it. And in fairness, it may well be something like health tech. Bitcoin is different. Bitcoin is not money. Money has a store of value, an asset of fixed value. Bitcoin does not. Over time, you will, however, see companies pay staff in Bitcoin. Retail, shops, banks will accept it. There are, however, a number of caveats. We had a boom and bust in Bitcoin in 2017. That started a 3-year bear market. It only rallied last October. It's now up, I don't know, sort of 400% or so. We've had new high-profile investors, indeed celebrity endorsement as well. You may recall Elon Musk saying he's going to send a manned mission to Mars, and in Mars, they're going to base the economy on crypto. However, what you're seeing is that other people are looking at it really as a way of a hedge against inflation. A weakening dollar post the US fiscal policy there. Now, in the old days, gold did that. I find myself agreeing with HMRC here in the UK. It's not currency, it's not money, it's an exchange token or an intangible asset. I think what I'd say to you, Claire, is probably what I'd say to the Martians. Absolutely, this is part of a diversified portfolio, but it is not money, it is very risky.
Joanne,
Totally agree.
any views from your readers and from people you talk to on your travels?
Sorry, are you talking to me?
Yes, Joanne, any views of your readers on the whole Bitcoin frenzy?
I think that a lot of the Mail on Sunday readers are quite cautious, and I think it's quite hard to invest in something which you don't understand, or perhaps not even hard, but not necessarily advisable to invest in something that you don't understand. And I think a lot of people don't understand what Bitcoin is. And when you see these huge gyrations in its value from 1 month to the next, that doesn't really, it looks more like the Wild West than a kind of a nice standard equity, or even, I mean, gold is volatile, but at least it's big and yellow and you can and it's tangible. So for me, I'd rather go for gold as a hedge against inflation rather than Bitcoin. But I do agree with George and you that the underlying technology, blockchain, has huge potential. And if you can tap into any of the companies that are either developing it or using it to further their own businesses, then that's a great way to go.
That makes sense. Makes perfect sense, Joanne. I mean, let's perhaps move to another hot topic. So the gamification of the market. So while social media is nothing new and continues to be a dominant force in all of our lives, perhaps we kind of first witnessed last year how social media herding can have a direct influence on the financial markets with the retail frenzy behind GameStop in the US. Is the panel concerned at all about what we saw in the US with GameStop and gamification of short selling through social media? Could this happen in the UK? Gervais, do you have any thoughts on that?
Yeah, I mean, I think obviously people can make money in these things, but is that always the correct answer? I mean, clearly we are to save and to save profitably and all the rest of it, but actually really, I mean, the ultimate purpose of saving is to make a durable return. And whilst you might be able to make a quick trade in this or a big money out of that, ultimately, if you just rely on selling it to actually generate your return, you just can get that timing completely wrong and end up losing money. And I'm sure lots of people lost money on GameStop as well as made it. So coming back to it, what is the purpose of investing? The purpose of investing is to take our collective savings and put it to work so that actually we generate a surplus cash in the long term. That's what a true asset is, something which generates a surplus. And then we can use to pay bills and pensions and all the other things which we want to do going forward. And of course, coming back to Bitcoin and the GameStop and all the rest of it, this is all just trading, right? It's not actually generating any return. And I think also having savings is quite a responsibility. It's not just about what we want out of it. We've got to think about everyone else, the electorate at large. And so it's not just about making money for individuals or people who are already rich, but actually to deliver something for the total electorate. Something which delivers perhaps skilled employment, something which delivers domestic growth, something which delivers particularly long-term extra tax take for the government. And I think all of these things are completely off patch. I think they're completely going the wrong direction. You have to be lucky to make money because you have to sell someone who happens to be braver than you in terms of buying these things. And more importantly, ultimately, it's actually not putting capital to a socially useful outcome.
Okay, thank you.
All I would say is that we have the ingredients here in the UK. If we sort of do a tear down on GameStop, we have the companies, we have the hedge funds, we have the investors, we have the venues, we have the chat rooms where you can create a swarming effect. What we don't have is that in the US, the voice of retail is louder. They can act in concert and make a greater impression. One of the issues that sort of defines the differences between here and in the US is that in the US you have a much larger retail component that is driving changes in asset pricing. But in terms of could it happen here, absolutely yes.
That's interesting. And I mean, on the topic of retail, opening up IPOs to retail, is that something that the panel is in favor of? How much protection is needed here of the retail investor?
Obviously, you need to protect or you need to provide investors with sufficient information so that they can make an informed decision. And at the moment, I think IPO documents are often, they talk a lot about, they're very legalistic. They seem to be more about kind of risk management than actually articulating what the company is, what the company does and what its prospects might be. It's quite hard to read through the sort of the legalese. So that's a downside. But I really agree with Hargreaves and AJ Bell and their sort of call to try and open up IPOs to more retail investors, because so often you find that an IPO, even an IPO which is very consumer oriented, is only available to institutions, and then they get the first slice of the pie, and then suddenly the share price has gone up and retail investors are left to the second take, as it were. So I think it's very important to give retail investors the option to invest from the beginning if they choose.
I think so too.
I think you make a good point there, Joanne, in terms of admission documents, prospectuses, containing so much of legalese, if you like, and investors really need to see the due diligence on the operating business to understand what the business does and the work and the look-see behind that.
Sorry, there was an interesting piece actually only this morning talking about IPOs in the FT, a rival paper, but I have to say it was a very interesting piece, just making the point that with technology as it is today, there is always the option of kind of live web streams and such. Like you can give a greater audience, a wider audience, and more insight into the company, directly speaking to the company or hearing from the company, so that they can make a more informed decision. Sorry to interrupt, Claire.
No, I think it's.
Can I interrupt on the subject of interrupting?
Please interrupt, George.
So I'm an institutional broker. My natural pivot is to institutions. Gervais, can I get you anything? Are you sitting comfortably? However, you are correct about AIM and the importance of retail, particularly in the AIM market. People like Gervais will have a halo effect, so they will bring in other investors, both retail and indeed other institutional as well. They also offer value in the sense that they see lots of companies and they can be a touchstone to one of their holding companies. So do it this way, don't do it that way. At the same time, institutionals just have large tickets. Their minimum size where they want to be in the market is way in excess of Mrs. Mitchell from Basingstoke, who wants to buy a holiday flat in St. Ives with the rest of us. And that will be small packets, which will direct in a generally illiquid market the direction of the share price. Now, clearly it's just economics 101 around the laws of supply and demand. However, companies need absolutely to be aware of the effect of retailers and small ticket sizes as they build their shareholder register.
If I could interrupt, I mean, I think the purpose of markets is to have two-way trade. So why wouldn't you have retail investors involved? So it always used to be, used to fill in a sort of form on the newspaper and send it in and all the rest of it. There was a lot of staggering went on, perhaps some of it was trading. But most particularly, the purpose of having institutions is so that you can go back and raise capital, secondary capital. You can go to your institutional shareholders and talk to that. But coming back to that, institutions often don't invest in small companies because there isn't enough trading. Well, let's get some more trading then. It seems like obvious, and then more institutions will come in. We can get to the finishing post here. So, I think therefore there have been some major changes recently. Investor Meet Company is a company where it makes it easier for private investors to engage with corporates. We are seeing as primary bid also giving more access to secondary placings and such like. So I think the general direction is to have more private investors involved, and absolutely let's get them involved.
I think all good points from the panelists. But if we move on to the next topic that I want to talk about, maybe it hits a bit of a brick wall with retail and IPOs. That being SPACs. So SPACs certainly exploded in popularity during the pandemic, reaching record highs, particularly in the States, and at quite a breakneck speed. I guess we would call them shells. And Vin Maria's kind of leading the craze here a little bit in London with advanced T raising 130 million to capitalize on opportunities in the software sector. I mean, she's a very special case, I think, and has made investors a lot of money in advanced computer software. So are looking to repeat that success with her latest venture. But is with a SPAC, with the arrival of SPACs, perhaps as a new form of IPO in London, is the panel still keen on retail involvement? And George, I don't know if Stifel are looking at SPACs and this way of bringing things to market, and if you just generally have a view on SPACs and perhaps how in a listed market environment they can perhaps compete with private equity for fast-growing tech businesses that you would look at, George.
Great point, Claire. Confession time. My colleagues have done 40 SPACs. George has done none. But you're right in that this is about enabling investors to gain access to earlier stage companies and compete with private equity. Well spotted on Vin Mariah and Advanced ADT. We may remember Vin from CSG, laterally Advanced Software. Those with longer memories, that's probably just me. Vin started out in Keywool Systems. So she's got a long track record in buy and build and creating shareholder value. So she should do well because she knows that end market. A lot of folks dismiss SPACs as it's just basically a blank checkbook, but in the right hands, that can be a powerful tool. So yes, they are happening, but they're not happening on George's desk right now.
Interesting. Joanne, is this something that you're looking at the moment, reading about it in the press in the States? Is it something your readers are interested in?
I mean, certainly looking at it and noting it. I think if we go back to our earlier discussion, fads are arouse suspicion. You know, when suddenly loads of money is pouring into one thing, you know, do you follow the herd and just blindly follow and just blindly invest, or do you actually sit back and think, hold on a minute, what is this company? Is this company capable of delivering sustained value? Do I know enough about it? Am I just going to sign money away without knowing sufficiently about what that money is going to be used for? Well, only a fool would do that, wouldn't they? Unless, as you say, George, if you've got someone like Vin Maria who does have that incredible track record, well, then you're backing her. And I'm completely in favour of backing known winners, but backing somebody who just happens to have a lot, you know, some sort of hedge fund billionaire or something that you don't know anything about. I think it's all about investing in the right companies is about knowing what you're investing in and what their likely track record is, or what their likely future is going to be. It's not just throwing money at a fad.
Gervais, can I bring you in? You like to see operating businesses, don't you, at Premier Miton?
I'm afraid so. I'm a bit old-fashioned, and I'm interested in the cash generation and all that. But so coming back to it, I mean, this isn't the first time we've had SPACs. They've come and go. It's just a phase in the market. When you get rampant liquidity in markets, people get excited about SPACs and they drive up the share prices. It's all terribly exciting. But in the end, all too often, it doesn't deliver long-term durable return, and that's what I'm interested in for my clients. So coming back to it, you know, I can't really see any reason to get involved in SPACs. To be honest, there may be some diversification benefits. You may be able to want back a certain individual, but generally, I don't see any opportunity. Let's be honest, you can make heaps of money in all sorts of stocks in the market at the moment, and most people have. That's absolutely fine. You don't need to get any more imaginative than that.
Thank you. Wise words, Gervais. We mentioned private equity a little bit there and the idea of SPACs and tech companies. So I think the continued bull run has shed a favourable position on private equity, and they seem to be in rather a win-win position. Private equity in bull markets, they take advantage of market demand and sell down on portfolio companies, IPO them, and in market downturns, they manage to serenade growth companies away from the public market. So we've seen quite a lot of private equity activity last year in the public markets, whether that be selling down companies at IPO or taking them private like AA. So what's the rationale for new investors to invest in a company when it could be perceived that private equity are selling? Is there the thought perhaps that the value is being stripped out? Anyone on the panel got any views there really on private equity IPOs?
I mean, if I can step in, generally private equity are very commercially sophisticated investors, and they tend to clear out most of the assets. So you tend to find there's an awful lot more debt in there. They won't own their properties anymore and any of those kind of things, which means that when things go wrong, and you know, some companies are successful, sometimes they go wrong though, is that there's much less left. You know, the downside is much more serious. You have to have new capital more quickly and all those kind of things. So the first thing is that actually the risk-reward ratio is not as attractive as an ordinary company, in my view. The second thing is they tend to choose when they list these, and they're choosing times when it's favourable for the company and they hope to get a good valuation and all the rest of it. And the third element is they even to craft it to make it even better. You know, the company concerned maybe doing a 2-for-1 offer for the first, you know, sort of 8 weeks before float or something, and that tends to make the like-for-likes just look that little bit better. And people think, oh goodness, it's trading above expectations, jump in quick. So generally, I am very cynical. That doesn't mean I'm right. And there are companies where perhaps the private equity people do sell out, and you can make heaps of money. William Hill came from private equity, for example, and it made heaps and heaps of money. So I'm not against it permanently, but generally, I think it's much, much better to get involved in second-hand equities or possibly new companies which are coming to market, not from private equity, but for other reasons. I think private equity have made, you know, obviously extremely attractive returns for their investors over many, many years, but I think that's just related to bond yields going down. And if bond yields stop going down, or indeed they start going up, I think private equity won't work nearly so well.
Thank you, Gervais. George, do you have any views on this particular question? And is it something that at Stifel you're working on IPOs? You probably have private equity on the other side, right?
To Gervais's point, PE does not own sophistication. There's lots of sophisticated investors in public markets as well, but it is true that they tend to be the source of new flow coming into the market, and that really reflects what do startups and younger companies, where do they go when they're looking for funding. And more often than not, they will, through their seed rounds, end up in private equity at some stage. And those private equity investors will themselves have a holding period and their own sort of escape plan in terms of their exit strategy, which may or indeed may not involve an IPO, or in fairness, you know, flipping it on to another PE company. And then they will make that decision every 3 years. Or so, but I think it's wrong to say that they own sophistication. They don't. Public market investors, and I do not in any way want to diminish the impact of retail investors, because a lot of retail investors are very sophisticated people as well who know what they're doing. But we must look at companies on their individual merits. In terms of business, and you know, absolutely, why is it coming to market now as opposed to later? Who are the existing owners, and what is their intention going forward?
Thank you, George.
I mean, there are clear, when you look back, there are some obvious the awful losers. Say Debenhams kind of is that case in point, isn't it? Aston Martin's been a kind of bit of a basket case, but then you've got companies like Pets at Home, which I mean, I don't know whether Bridgepoint regrets having sold it when they did, but you know, it's obviously done fantastically well in the past year. I don't think you can, as my co-panelists have said, you can't kind of blankly say all private equity companies or all private equity companies that come to the market are bad. And also, to George's point, a lot of private equity firms these days, they sell to other private equity firms. So they can't strip out all the value. They've got to be thinking about the exit, and the exit becomes more attractive if there's some growth left in the business. I think you just have to look carefully.
Thanks, Joanne. And I think very useful comments as well from you, Joanne and Gervais, on fads, and just warning our audience a little bit against kind of the fads that we find in the current bull market. And it makes me think, do bull markets create the investor desire for quick wins, instant returns, which is perhaps completely at odds with the time it takes for many small caps to thrive? So just asking the panel, coming back to this point that I know, Gervais, you've talked about over the years, patient capital. Does it exist in small caps anymore? You know, you need to be patient for many years sometimes for smaller companies to prosper, and it takes years, and then something clicks and away they go. Do investors right now have the patience and understanding to back small caps?
I mean, I would argue, of course, institutionally, because we're investing larger amounts of money, that if anything, we have to be patient. I mean, you can't get in and out. There isn't liquidity. You can't just change your mind every 5 minutes. So coming back to it, actually, you might argue that big caps might have less patient or impatient capital, whereas actually small quoted companies, actually, particularly micro caps, have more patient capital. So I certainly think it's there. Most particularly, the great advantage of small quoted companies is that they can You know, they can grow a little faster, they can produce premium returns, they can do transformational transactions. And so ultimately, I would argue patient capital isn't just the ability to wait and invest, but actually the ability to hold back and actually not invest for a period, having cash ready to invest so that you actually wait for the company at the right time to invest. And I think that's a very key area of the small product companies in this market. There's such a wide range, there's such different sectors, but is, you know, the opportunity of actually raising money in distressed circumstances when markets are low and the opportunities are so much better is absolutely the key area. So coming back to that, it's down to us as fund managers to engage with our clients and get them to be patient. Actually, it's not just about us, it's about our clients. And the great advantage of small credit companies is they are perceived as less liquid, and therefore, generally, we do have that relationship.
To that, I'd add actually, small caps are hard, and micro caps are even harder. What we have in the UK is a group of entrepreneurial fund managers who are by design patient and to some extent long-suffering as well. As long as the company is delivering to plan and communicating, they will support the companies. In the US, this does not happen. In the US, as Joanne said, you cannot IPO small companies. Here we have sophisticated investors who appreciate that smaller companies, and not just my own patch in terms of software companies, but they do find themselves in blind alleys from time to time. I will save Gervais's blushes. He is one of a small few. You've got Octopus, Downing, Herald, Unicorn. My issue is that there are just too few of them. Larger investors with larger tickets may look attractive, but the smaller specialists actually work with the companies and better understand their risk profiles. In addition, with tech, it is always a journey. But if you appreciate the two of the largest tech companies on the market, so that's Aviva at a 10 billion market cap, Sage at a 6.5 billion market cap, these both started out as mid-30s IPOs that struggled to get away. Patience can be hugely rewarding.
And George, should we be encouraging some of the more blue chip UK institutions? Should we be compelling them to back microcaps as they once used to? You're saying that Gervais is a and it's correct, a very small group of institutional investors that back small caps. Should there be some compelling of our institutional investor world to look more clearly at microcaps and not to define their microcap investing as $500 million upwards?
Yeah, I wouldn't like regulation. You could say address this with regulation. I would like to see behavioral change prompted by investors just being rational individuals, which they are. If they can see a formula for making money, usually they will press the rewind button and say, let's do that again, more please. The issue is really about getting some great companies into the market, making people money, and then more people will just naturally come to the party.
I would have thought that technology can be really helpful there, because often the problem has been it's difficult for a smaller company to communicate as effectively as a larger one. But today, those kind of that differentiation is much narrower, because you can, with a little bit of ingenuity, you can communicate much more widely and tell your story much more widely. So perhaps what we actually need is not necessarily regulation to compel people to invest in companies, which I think, agree with you, George, would be a bad thing, but just encouragement, or kind of working out ways to help them tell their story to a wider audience.
Yeah, makes sense.
But on the patient capital front, I mean, we're not just talking about tech companies that are trying to, you know, that may take a while to get going. You've also got these kind of long-running family business. I'm thinking of, say, James Halstead, the floor covering business, dividends for the past 40-something years, you know, patiently growing year by year. Real, I mean, not every company is real, but companies making real things. Often family owned from the start, just growing gradually year by year. or Treat, which has been a fantastic success, the flavourings business. Started out as a family business, grown patiently. I mean, I don't think you can say that retail investors don't have the patience. I think I agree with you, Gervais. They do, and they have to.
And I think that's value, I guess, that we're talking about here: value investing versus growth investing, and it is value investing over at the moment. It's not really attracting the investment perhaps that some of the growth market IPOs that we've seen and fundraisers have been much more about growth. It seems that investors are drawn to fundamentals around sensible PEs and bottom line performance have been left out, certainly from the fads that we've talked about, some of the biotech and blockchain plays. Value hasn't perhaps done so well since the dot-com crash, really. Is this the end of value investing in smaller companies? Is the adage of you get what you pay for true, or is there still some genuine valuable bargains at the smaller end of the market? Gervais?
Yeah, I mean, it's kind of interesting. I probably don't draw the line between value and growth quite as simply as a lot of commentators. I do think that you can get companies which are overlooked, perhaps on low valuations, which can grow very happily. And you can get some companies which are making losses and have exciting growth plans, where for whatever reason, they never quite lived up to their expectations, even though they do everything right as a management team. So I'm probably less inclined to make that division, but most particularly, I absolutely do think that there has been a real theme towards companies which are generating very substantial returns in future, which are forecast to grow rapidly, because the net present value of that, as you get lower and lower discount rates, has meant that actually the net present value keeps going up, and these companies have delivered abnormally large returns. We look at some of the unicorns in the US, and it's just extraordinary that a loss-making company can grow to those kind of sizes and continue to get support, even as they make more and more losses. So as a starting point, I think that's kind of where we've been. But most particularly, you can still make very, very handy returns. And I'm terribly old-fashioned. And as I said, I really like companies which generate a surplus of cash in the long term, and without generating that surplus of cash. And you can get that in technology companies, like Apple and Microsoft and many others. So it's not against technology. But I do think we need to have that in mind when we're investing. And far too often, these kind of growth companies become very growthy, but they never really get to the finishing post in terms of generating surplus cash, which they expect. And so I think that coming back to all of these kind of issues, I think that actually valuations are being driven up by bond yields, which are very low, i.e. ultra valuations of bonds are ultra high at the moment, and every asset is nearly expensive, except possibly UK assets because of Brexit, and most particularly small companies, and most particularly microcaps, where perhaps they've been out of fashion because of Brexit and because they're generating cash and they're not unicorns and all that kind of thing. And it is just embarrassing, to be honest, some of the valuations you're able to buy companies on. I'm trying to buy a company, I'm not to say what it is, but I think it might be on a PE 1.5 next year. And you just think, that can't be right. That can't be right. We're at the end of a bull market. How can they be like that? Is it all over? Certainly not. I do expect, the UK to outperform. I think as before, small companies will probably outperform and microcaps outperform a bit more. I think that's what, just give it a bit more time. And we'll see what the scores and the doors look like once we've gone through this next patch of market iteration.
Thank you, Gervais.
I agree that smaller companies can suffer from inefficient market dynamics and, in fairness, from regulation as well. So for me, MiFID II acted to the detriment of smaller companies. So yes, there are absolutely bargains out there, but we always need to ask, well, why is this cheap? So, for example, is this cheap because it's about to go bust? Is this cheap because the forecasts just aren't credible? So in fairness, it's not actually cheap, it's very expensive. To illustrate, I initiated on a company called Cape Technology recently. It is cheap because of a legacy. Folks remember what it was rather than what it is now, i.e. new management team, 300 million of new investment, 6 acquisitions, spun out in a completely new market. Now, 4 years later, still hemmed in by market memory, which is acting against it. lots of upside, and delighted to say that a certain institutional investor called Premier Asset Management is one of their long-standing and very patient investors.
Thank you, George. Slightly different perspective, but we've perhaps covered it. So looking at the best performing shares last year, Liquidity, we haven't talked about Liquidity. We kind of have, but we haven't mentioned it. So they tended to be the most liquid. Are investors prioritizing the daily volumes, the liquidity over PE ratios? So not just looking at the fads, but the underlying trading of these shares. And it sometimes, look, the liquidity is being used as an excuse to avoid measured risk taking, because it's okay, we can get in and out of that one. So perhaps the DD is a little bit less, which ultimately has to be to the detriment of UK PLC. So one for our panelists, can small caps, can a company have both sound fundamentals and have lots of volume going through? Are these at odds? Do you look for one or the other, or both?
In terms of my lens, sort of my best performing stock in 2020 was a company called the Panopoly, TPX.ln. If you're looking at it, it was up 134%. It was up, it's up 44% this year. It's up 265% since its IPO. That's a UK IT service company servicing UK public sector. It's growing. It pays a dividend. It has a tiny free float, and absolutely the lack of liquidity has been, classic supply and demand has been one of its drivers. But it is paying dividend. It is creating employment and adding value into the UK, and is not liquid at all.
Yeah, so I actually recommended that as one of my shares. Sorry, Gervais.
No, you go on.
Sorry, it's because of Joanne.
Yeah, I recommended it last year. I'm very pleased it's one of your top performers, George. Great company, and I mean the chief executive is inspiring. I think. Yes. For me, when I'm talking to companies, who the management are, what they've done, and what they want to do is a lot more important than the liquidity in the stock, because I'm not recommending shares to my readers as, get in and get out quickly. I'm recommending shares that I hope that they will hold and make money from over a much longer period of time. And also to Gervais's earlier point, that companies that will have a wider economic benefit to the country in whichever way, or social benefit. But so it's not about, for me, it's not about liquidity versus fundamentals at all. It's all about, is this a business that is going to make money?
Absolutely. I mean, I think as well, when it comes to these kind of things, the biggest risk which clients face when they invest in individual stocks is actually permanent loss of capital. There are other things which you can worry about, liquidity and such like, but they're transitory. If it takes a bit longer, so what? So from that point of view, I think liquidity is perceived as a worry, but actually it's really not. It's basically a molehill compared with a mountain. But coming back to liquidity doesn't just mean one thing. Liquidity can mean you can't get out, and often people who get in a company which doesn't do well, they're desperate to get out. They're really unhappy because there's not enough liquidity for them to get out, and that's really what they often mean by liquidity. But liquidity can mean you can't get in. Actually, if you're an institution, you want to buy this stock, and you just can't get any volume, and that's equal liquidity. And so the advantage of things like small companies is when they come right, and people want to get in, and there's not enough shares around, that illiquidity can see their share prices go an awfully long way. It's not always a bad thing, liquidity. It can be something which actually allows share prices to outperform. You can't pay this price, so you have to pay up. How often the company gets access to capital at a lower and lower rate of return, so they actually can get a better opportunity for delivering extra return for their clients. Ultimately, I'm very comfortable that markets are based on liquidity, and we need to maximize liquidity. But small liquidity in small companies doesn't need to be a negative. Coming back to returns last year, many of the companies which did perform the best were relatively small, illiquid companies. You think of Avacta, perhaps, which was only 15 million at the beginning of the year, and it's gone up to about 500 at the end. Basically along the way. And so from that point of view, there's great advantages to find the right companies, even if they are slightly illiquid.
Thank you, Gervais. Thank you. So maybe let's bring this back to London and the various dialogues that are raging right now around the listings review. So London has only accounted for 5% of global IPOs since 2015, perhaps due to some of the regulation, MiFID II and overlay, very complicated regulation that we've had for the last while. Earlier this year, we saw Amsterdam overtake London as Europe's largest share trading centre. A shift that's perhaps seen as a direct result of our exit from the European Union. Certainly the current listings review with Lord Hill is looking at some of these issues to try to keep the question of the UK's attractiveness under review. And I know the Quoted Companies Alliance is battling with this on all of our behalves, which is great, and our thanks to them for doing that. The question for you guys this morning is, how do we find the right balance in the listing rules to ensure the market's attractive for new companies, whilst at the same time addressing investor concerns around good corporate governance? I suppose it's coming back and looking at the idea of SPACs or not, or dual class share structures. We've seen discussions there with the Hut Group and now Deliveroo, the latest company to opt for those dual class share structures. Do we think a free float of 15% is a good idea? Any views on the current discussions around the listings review?
My only point is that I wish there was more discussion on it, and well done you, Claire, and the QCA for trying to push this. I read Hill and Khalifa, I don't know if you saw that one either, with increasing despair as these people put together documents which basically court companies rather than understanding a point that Gervais made about a marketplace where you must have buyers and sellers, and the sort of the current dialogue is really just talking to the companies and not really listening at all to the requirements of investors. And the key thing here is that you are creating value over the long term, not looking for a day one pop. So I find it very disappointing that Hill and Khalifa cannot pivot their thinking to what do investors need to see in order to invest in more IPOs. I was somewhat encouraged, you mentioned Deliveroo, to find some investors saying we will not invest in this because of the dual class of shares, which is something that the reviews are promoting, and also flagging up low liquidity, although I think low liquidity is less of an issue. We need to remember that institutions are looking after funds of nurses, doctors, care workers for the long term, and will not be happy with the day one pop and then flip on to something else. So governance has to absolutely not be forgotten in this process.
I mean, when it comes to governance, I mean, you know, the UK actually has a sort of history of leading the world in governance since the '92 Cadbury report. And it's not just adding cost, it's absolutely working with companies to manage risk. You know, this is about identifying things which are tense and perhaps not perfect in a board or in a company, and addressing those. And over the years, you know, I think this ESG, you know, environmental, social and governance, has become fashionable, but it's always been there for good investors to work with companies to minimize risk. I think the UK actually is unusual in actually probably being ahead of the world in terms of engaging on climate change now. We want our companies to talk about their carbon footprints. We want them to identify and how they can scale them back. And if anything, I think that'll bring more investors into the UK in due course, not so much just into the UK market, but into UK fund managers, who I think are probably leading the world in this area. So I think there's lots of things about this debate which are good. And yes, you know, you can have dual capital structures, and some people will invest and some people won't, and they'll have different outcomes. But most particularly, it's the variety. And I think that, you know, whilst, you know, Europe and such like may get more volumes because of their regulations and we can't trade in London the same way, I think as long as the UK absolutely continues to have this right kind of mix of companies quoted, but managing risk without leading to too much cost, specifically proportionate disclosure, so that all companies don't have to do the same thing as Rios and such like. I think that's ultimately going to deliver attractive returns, and it's the returns ultimately which will bring.
Yeah, I think that's right. I mean, the amount flowing into ESG funds in the UK has ballooned over the last 3 years. I think was certainly very much leading the way, and the money and sometimes younger money is chasing companies widely considered to be good. So perhaps for the first time publicly, ESG is being, I mean, for the first time publicly, you mentioned Deliveroo there, George. I think there was an element also of ESG has been cited as a reason for investors turning down IPOs such as Delivery, along with the institutional investors as well, that voice their concerns over ethical practices, workers' rights, and so on. So, but can investors really be critical of certain ESG policies when you look at the portfolios of some of these investor groups and their own portfolios are kind of, you know, littered with fossil fuel and fossil fuel companies, tobacco companies, and so on? Anyway, Joanne, you'd like to jump in?
I think it's very easy to, I mean, I'm very much in favour of reducing greenhouse gas emissions and such like in companies that are doing, trying to do that in one way or another, either through technology or kind of renewables or that kind of thing. So I'm definitely in favour of it, and probably going to be writing about a company that's in that vein this weekend. But again, I think it's really, it's easy to say, right, no BP, no Shell, you know, no tobacco companies, or tobacco companies, it's a slightly different case, but I think with these big oil and gas majors, they are the ones that can probably make the biggest difference in terms of if they've got the money to change the way that they operate, they can do it. But if they're completely starved of funds by debt and equity markets, they won't be able to do it, and they'll just get dirtier and dirtier. So I think there's often a sort of simplistic approach to ESG, which doesn't capture the real drivers of change, or the potential drivers of change. I think we have to be careful.
I agree, and I think actually when you look at, you know, of course, you know, sustainability funds are excellent because you just focus in on sustainability, but really we want the change of behaviour in those companies which aren't in the sustainability funds. You know, you want the cement companies to do something about reducing their carbon footprint, and the oil companies and the steel companies. You know, those windmills are great. Vestra are a very good company, but you've got to worry about that 800-ton steel they put it on, and the concrete foundations which are made of cement. So I absolutely think this is a much wider debate. And as I say, you've got to link it all up. Certainly, sustainable companies, give them a premium because they're doing things. Let's bring all the others, leave no one behind.
Thank you. So conscious of time, we're nearly out of time, I think. So we should probably end on this positive note of ESG and sustainability and impact investing. Thank you to our wonderful panelists who have been brilliant. Thank you very much to all three of you. Happy Easter to everybody. Thank you for listening in. And to close out, would like to hand over to Daniel Bellau, Corporate Finance Partner with Edwin Co, to make the closing remarks. Thank you, Daniel.
Thank you very much, Claire. And thank you so much to the panel for a really highly insightful discussion. I mean, I think given the level of activity that we're all seeing in the market, and we at Edwin Co have seen really a huge number of deals, an explosion of deals on the ECM, on the Standard, on Equities, on AIM in the last 2 or 3 months. And I think that really endorses the optimism that you guys have shown, albeit it's some cautious optimism. And I think Lord Hill's review gives us you know, pause for thought and some, you know, gentle excitement about what the London market can bring post the you know, Brexit confusion that we hopefully will begin to emerge from. And I think we're looking at a very positive year ahead for our small cap community. So thank you, everybody.